Investing in the stock market, the only way to get a good price is to buy what the crowd wants to sell and sell what the crowd wants to buy. Buying a company at a good price means the downside is smaller than the upside. If you are wrong, you won't lose much, but if you're right, you could make a lot. The best investors know this. While the crowd imagines the trend continues forever, deep value investors and contrarians does the opposite thing. So how do we know what stocks are undervalued or not? Well, that's where we go to this book. Here are 5 lessons I learned from the Acquirer's Multiple by Tobias Carlisle. But before we start, would really appreciate it if you support my channel by clicking the like button for the YouTube algorithm. And if you aren't still a subscriber, would also recommend clicking the subscribe button as well. With that, let's start. Lesson 1. You zig when others zags, and zags when others zigs. What does zigs and zags mean? In short, you buy what the market is selling and you sell what the market is buying. So we buy undervalued companies that people are selling and sell expensive stocks, or might as well stay away from expensive stocks that the market is buying or the hyped up stocks. But there's a catch here. You don't just buy companies that the majority of people are selling. No, you don't just buy because they are cheap. You buy cheap companies that you want. This means as a value investor, you should know what the company is about. The teacher of Warren Buffett, Benjamin Graham, emphasized on this. You are partaking in a business. It's not just a mere ticker symbol. It is a company. So you should think like an owner. You should know what the company does. What is the business? How does it make money? You should know what it owns. What are the assets? What are the liabilities of the company? You should know who runs it. Is management doing a good job? Are the big shareholders paying attention? A lot of investors often skip this part. They just rush in and base their investing decisions on what other people say without even looking at what the company does and how it's doing financially. Lesson 2. Boring creates opportunities. Have you ever analyzed a stock and it checked out all of the lists in your checklist and you wondered, why the heck is their stock price going down and down throughout the years? Well, the crowd often overreacts when a company hits a bump in the road, which leads to the stock price dropping. Or sometimes, the business is boring, wherein people don't often look at it, and investors who have invested in it gets impatient. When undervalued companies owns a boring business, sometimes all it needs is time. A seemingly poor business with a lot of asset value can be a good bet. If the business improves in time, it can be a great bet. Lesson 3. Mean reversion. Everything goes back to normal. Mean reversion is a phenomenon in the stock market. It pushes up the prices of undervalued stocks and it pulls down the prices of expensive stocks. It returns fast-growing and high-profit businesses back to earth, and it points business with falling earnings or growing losses back to the heavens. It works on stock markets, industries, and the whole economy. We know it as the booms and busts of the business cycle or the peaks and throws of the stock market. Now, how does this happen anyway? How does the high-growth, high-profit stocks fall back to the average? And how does undervalued stock rise to its fair value? Well, the most simple explanation for this is because of competition. Fast growth and high profits attract competitors, entrepreneurs, and businesses in related industries. Losses cause competitors to fold or simply leave the industry, and the lack of competition creates a time of high growth and profit for the surviving businesses. Now, profit margins are probably the most mean reverting series, and if profit margins do not mean revert, then something has gone badly wrong with capitalism. If high profits do not attract competition, then there is something wrong with the system and it is not functioning properly. With that understanding, Buffett mentioned something about this. You must be wildly optimistic to believe profits can remain high for any sustained period. So this is sometimes applied when projecting future earnings. You must be madly optimistic if you are computing for the intrinsic value of the company and putting in such massive growth rates. But what causes this mean reversion for stocks? How does expensive stocks and undervalued stocks mean revert? The answer to that one is investors, fundamental investors and value investors. Undervalued assets and profits attract investors. Value investors and other fundamental investors start to buy stocks and push up stock prices. Expensive assets and profits cause those investors to sell. The selling pushes down the stock prices. Mean reversion has 2 important implications for us investors. 1. Undervalued, out of favor stocks tend to beat the market. the more undervalued the stock, the greater the return. Value investors call the difference between the market price and the underlying value the margin of safety. This we will discuss later. Fast growth or high profitable businesses tend to slow down or become less profitable. Declining or unprofitable businesses tend to do better. Just imagine this one. Once a company grows even more, the percentage of their growth will slow down. This was said a while ago. You must be so optimistic to think a company can maintain their 20 to 50% growth rate. Lesson 4. The acquirer's multiple. Now, the acquirer's multiple is just like the ratio that all of us investors knows, which is the PE ratio. But this one takes it to a higher level. Just to compare them, the PE ratio looks at the market cap alone and divide it to the net earnings of the company. A low PE ratio means the company is more undervalued. For the acquirer's multiple, it doesn't just look at the market cap of the business. It also takes into account the debt and the cash of the company. This is called the enterprise value. So why does it take into account those things? Well, when you are buying a business, you don't just take into account the business's market cap. You also acquire the debt and the cash they have. So buying a 10 billion company with 5 billion in debt is just like buying a 15 billion company because you also acquire the debt that the company have. You still have to pay it. Meanwhile, when a company has cash as well, you also get that one, which is better. So if you bought a company cap worth 10 billion that has 5 billion in cash, it's like you've bought it at 5 billion. Unlike the company with 5 billion in debt, see the difference? Both companies have market cap of 10 billion. So in your thought, oh, they have the same price tag. But what you don't know is, one company has a lot of cash in hand, meanwhile the other has a lot of debt. So this is what enterprise value is. Instead of just looking at the market cap alone that only looks at the tip of the iceberg, you also see through what's underneath the water. Moving on, the acquirer's multiple also doesn't use net earnings. It uses operating earnings instead of it. This is taken by revenue minus cost of goods sold, minus selling, general and admin costs, minus depreciation and amortization. In the income statement, they have already computed it for you, which is operating income. With this, if you get a lower acquirer's multiple, the better. Much like the PE ratio, this means this company is more undervalued. Now, the only downside to the acquirer's multiple, it's a bit more complicated to compute. They have a website which already have a computed acquirer's multiple for companies, but sadly, it doesn't have, I think, Philippine stocks. So you have to manually find these things in the financial statements, but it's quite easy to find it. For enterprise value, everything can be seen in the balance sheet, the debt and the cash. For operating earnings, it's in the income statement. So how does this stand up to Joel Greenblatt's magic formula and the index? Well, for our example here, they just choose 30 companies that have 1 billion cap and has the lowest acquirer's multiple, with $10,000 initial investment from 1972 up to 2017. The acquirer's multiple had an astonishing compounded return of 17.9% compared to the magic formula, which uses the PE ratio, had only 16.2%. Huge difference, especially from the S&P 500. Our next example is with Pure Charlie. Now this one invests in highly profitable companies, which still beats market returns, having 13.7 compounded return, though it was still not enough to match the magic formula and the acquirer's multiple. Lastly, lesson 5, margin of safety. Again and again, with every formula out there that tries to find the intrinsic value of a stock, we always use a margin of safety. In security analysis, Benjamin Graham stated, "The secret of sound investment is 3 words, margin of safety. The greater the company's discount to its value, the bigger the margin of safety is. The bigger the margin of safety, the better the return and the lower the risk. This allows for ordinary errors in calculation of value, and it allows for any drop in value. It's like a cushioning effect for us investors. In the acquirer's multiple, such margin of safety can also be found in the balance sheet. A company with more cash and less debt is a much better investment. This also gives us that margin of safety since the company doesn't rely on too much debt to run the business. In a company, you can also find a margin of safety through their business. The company should own a real business which historically have strong operating earnings with a good cash flow, which confirms earnings are real. With this, combine the 3, having a discount from the value of the company itself, having a great company that doesn't rely on too much debt and has strong earnings. That is a great margin of safety for you. Never invest without a margin of safety. Now, I have a video discussing margin of safety. If you want to watch it, link in the description below. With that, that sums up the 5 lessons I learned from the Acquirer's Multiple by Tobias E. Carlisle. Now, with such a simple strategy, it beats market returns by a landslide. If you see how they do it, same as the magic formula of Joel Greenblatt in his book, The Little Book That Beats the Market. What they do is simple. Try to make investing as passive as possible. You just choose the companies with the lowest PE or acquires multiple and repeat it along the years. Because really, it has been proven a lot of times that too much activity sometimes could lead to your downfall in investing. This just sums up the reason why a lot of actively managed mutual funds don't beat the index. Making your investing more passive and as ground rules to follow makes you less prone to certain biases. This is what a lot of investors often make mistakes, computing for the intrinsic value of the company by using massive growth rates because they hear the news about the company that their projected earnings are like this. Oh, the company is recovering. We should also use massive growth rates. These kinds of things often makes you use exaggerated projections for the company, leaving you as an investor buying at a higher price. That's why in my stock analysis videos, I just show you guys what the company has historically done. I don't include projected analysis or plans of the company that hasn't even been started yet or what the analyst says. I want sound proof when valuing companies. This makes me less prone to biases. I want a more passive approach to my investing style. I just buy the cheapest company in my watch list. If the company reached my intrinsic value, then I would analyze if it's time to sell or not. I also use the acquirer's multiple as one of my metrics for analyzing if a company is undervalued or not. I combine it with my investing strategy, almost the same as the PE ratio. It shouldn't just be used as a sole metric of analyzing a company's worth. You have to look through the financial statements and you have to know what the company is about. You have to know first the company. Don't just determine the company's intrinsic value and solely rely on that. Just like what the book tells us, you are an owner of the company, so act like one. With that said, that ends this video. If you have gone this far and still haven't clicked that like button, please would really appreciate it if you click that button. And if you still aren't a subscriber, do click that subscribe button as well. With that, thank you and see you in the next video.